Okay, so this is just part two of two, going over moving averages. Okay, so we talked about some different strategies. We talked about the 3 EMA crossing the 9 EMA for a scalp strategy. We talked about the 9 EMA crossing the 20 EMA on the 1 minute or 5 minute chart, or a shorter time frame chart as just a regular day trade. Some people, for swing trades, they're looking for the 50 EMA to cross the 200, right? If it was in a downtrend, they're looking for that trend to change, right? So, and we looked at some different strategies. You can even look at it on, let's look at the pound yen here real quick and see how that works. So for anybody that does any forex trading, let me try and find something interesting. Okay, here we have an up move and a down move. So let me get rid of this RSI down here. We don't need that. Okay, so here we have another cross, right in that area. Okay, so we have a cross here. Again, depending on where you're comfortable. Are you comfortable getting in before confirmation, or do you want to wait for confirmation? Do you want to wait until these 2 EMAs have a gap in between them? Again, that part is totally up to you. But let's make a few trades here and see how it would have worked out. Now, keeping in mind, we're going to just assume that we had several other indications telling us, yes, this looks good. We're not just trading it based solely off of the 9 crossing the 20. Okay, so we took the trade here, and let's say that our rule is we don't care how high it goes. We're going to just hold it until the 9 EMA crosses back below the 20 EMA. So we picked it up here at this level. So we're going up. We haven't crossed yet. We haven't crossed. We're getting a little tight here, but we didn't cross. So we didn't cross until here. So again, would have been a nice profitable trade, right? So let's look at the next possible setup here. Just showing you guys how you can use, not just using EMAs where you can possibly look for a bounce when we're day trading, but where you can also use it as a strategy and make trades based off of EMAs crossing, right? So the next trade would have been if you wanted to short, you could have taken a short position here, right? And you could have gotten out here, or you could have gotten out here, or you could wait all the way until you cross back above the 20 here. Okay, so that would have been another possible trade. And keep in mind, whenever you start doing that, there's never any guarantee that by the time it crosses back above that you're going to have a lot of profit. So sometimes it's a good idea that when you've seen a lot of profit after this cross here, and you dipped all the way down here on this candle, maybe you want to pick up some profit there, right? So that's why scaling out can always be a benefit, right? Okay, so we crossed here, and if we didn't wait for confirmation, then likely we would have gotten stopped out. See that? So if all the other indications said, hey, yeah, that looks like a good trade, and we went ahead and took it, and we didn't wait for confirmation, it likely would have hit our stop loss. So this is why it's a good idea to wait for those confirmations. But aggressive traders, won't do that. They're okay with having, those handful of losses because their gains are bigger than their losses. So they're fine with that. So our next possible trade would have been here, a long trade whenever the 9 crossed above the 20 at that level there, right? So let's see where we would have gotten out. If we didn't scale out any here, we just rode it all the way back down, because our rule says, hey, I don't care how high the price goes. My rule says that this is hypothetical. This is not my rule, just hypothetical. If a trader had a rule that says, I don't care how high the price goes, I'm going to wait until it crosses back below, then you would have gotten out here. So, and still would have been a profitable trade, depending on where you got out in this candle. I don't know at what point this cross happened during this candle. So if it happened down here, then yeah, you would have actually lost some money on that trade. So again, another example of why scaling out is can be beneficial. It's not always beneficial, because sometimes you can scale out and this thing just boogies on to the moon, and you end up missing out on profit because now it's way up there and you don't have 100% of your trade. But I've found that more often than not, I'll put more green in my pocket by scaling out, which is why I do that. So another trade here, if you wanted to go short, you've got an entry here, and your exit would have been here, but you certainly could have scaled out on the way down there, right? So, and that's what that reverse button is too. You'll see on your platform a lot. They have that reverse button. So as soon as you're in this thing long here, right, and then as soon as it goes breaks down below, well, now you hit the reverse button, and now your trade switched. Now you're short, and you're going down there. Come up here, you hit the reverse button again. Now you're long again. And you just ride this thing like a roller coaster, right? So those are just some examples on several different stocks and one forex that you can, and we can check more. Basically you can just go and just back test this thing yourself. Take a look at several different stocks or futures or forex or whatever you want to take a look at, and back test it and see what's happening with them. Okay, so let's real quick talk about then when we're using, let's say that this is one of our strategies. We're a moving average trader, and our primary strategy with moving averages is crossovers. So where can we put our stop loss on some of these trades? Well, there's a lot of different examples of where you can put your stop loss. I would say a couple common strategies are, well, number one is going to be at your risk management percentage, right? So you want to make sure that any of these other stop loss points are not going to be below or make you lose more money than your risk management plan says that it's okay. So make sure that it doesn't do that. But a lot of people will use ATR. They'll use 2 times ATR as their strategy, right? If you don't know what ATR is, it basically it's average true range is what it stands for, and basically it just looks at the volatility of the last 14 candles. Okay, depending on what time frame chart you're on, it's just 14 candles. So it just looks at the volatility. So it's showing that, hey, in the last 14 candles, it's had this much volume. So this is how much it can go up or down, right? So if you go 2 times that, then likely, based on that ATR, you're not likely to get stopped out and then it going back up, or getting stopped out and then it going back down if you were short in the position. So some people use 2 times ATR, and you can find that very easily. I prefer a number. There are some platforms that'll put a number up here in this left hand corner. I know TradingView does, and it's really nice, but here you have to put it goes on your chart, which is kind of a pain in the butt, but here's what it looks like. And then you can just you really kind of just care about the number, so you can flatten this down like I do RSI. You can just look at the ATR number right there. So but anyway, that's one way you can identify a stop loss. And then another way is, maybe you say, well, hey, if it, I don't care if the 9 EMA breaks below, but if a candle breaks below, like it did here, breaks below the 20 EMA, then I'm out, right? Maybe that's another stop loss area for you there, right? Or maybe if it breaks below the previous candle, like the closing of the previous candle right before you entered. So let's say you entered here and your previous candle below that was at this level, right? So you would draw a little, put your stop loss maybe here. So if it broke below that, you're out, right? There's several different ways to identify stop losses on these things. So, or maybe your stop loss, if you have a heavier risk management percentage, you're able to risk more, then maybe it's below the previous swing low, right? Maybe it's below this level here. That would be a pretty big gap. But hey, if that's what your risk management plan says is okay, then maybe you go below this swing low. because it certainly could come back down and bounce off of that where it bounced before and bounce right back up, right? So maybe that's where you put your stop loss. Or once again, if you can put your stop loss right where the 9 EMA crosses back below the 20, if that's the strategy that you were using, right? Or maybe it's at a key support level. Maybe we have a key support level here for whatever reason, right? We had a support level drawn here, and so you're going to put it just a couple of a few ticks below that support level because it's been holding that level, so you're okay if it comes back down there. But if it breaks below that support level, price is likely to continue down, and that's where you want to have your stop loss. And of course, like I said, that's your risk management plan. So there's a lot of different ways you can do that. And so some of you might be saying, well, hey doc, I have a full-time job, and I really can't trade as much as everybody else is trading all throughout the day. So how can I implement this strategy? Let's say I want to check this strategy out and see how it works for me. So how can I implement this strategy not day trading because I'm working most of the day? Well, you can do that too. So let's go back to this semi, let's say. Or you know what, let's just stick to what we were on a minute ago. Let's might be easier. Let's go back. Or we can look at the euro, the euro yen. Okay, so you switch this to let's switch this to a daily chart, right? So if you're looking for maybe a longer time frame chart, you can't day trade. So you want to maybe take a longer time frame trade, right? So you can do this. You can watch for the daily chart for the same exact thing to occur. Okay, just keep in mind when you do that, two things are going to happen. Number one, you're not going to have as many setups, right? Because you can go days or months or even a year or more before you have your setup show up, right? Maybe on that particular stock that you're looking at, maybe the 9 EMA hasn't crossed below the 20 EMA for 3 months. So maybe you only get one trade every 3 months or whatever. So keep that in mind. And also when you're doing trades like this, you're going to end up holding them longer, So keep in mind, this is a daily chart. So each one of these candles represents a full day. So here's your entry is here, right? Your confirmation candle is here, right? So you've got a confirmation candle. You've got the widening of bands a little bit here. Would you have gotten stopped out here? I don't know. That depends on your risk management plan. But I can tell you this, the 9 EMA has not crossed back below the 20 yet, okay? So if you got in here or on confirmation candle here, you're riding it up. But keep in mind, this is, we took this entry in January of this year, okay? So it's going to be, this has the potential to be a very long-term trade. Or you can hop out of it here, you don't have to wait until it crosses back below. You can take your profit anytime you want. But I'm just showing you an example of if you're not able to day trade, how you can do longer term trades using this particular strategy. So if you hopped in here at this cross or on the confirmation candle, you're watching this 9 EMA every day, you're making sure, you set up an alert, you can have an alert on your platform that says, hey, I want to know if I'm not able to watch it every single day. I want to know when the 9 EMA breaks below the 20 EMA. So it still hasn't broken below, So you're still riding this thing up. Now you got into this thing in January, and it's still trucking. Right now it's May, and you're still going. Now it's June, and finally in June it broke below right here, right? So that's an example of how you can use this strategy other than a day trade, right? So you can use it, and if you're like, hey, I'm kind of in between there, so I can look at the chart or look at my trading, my phone, whatever you're using, a few times throughout the day, right? Well, that's cool too. Hop on the 1 hour chart or the 4 hour chart, right? If you're looking for more of a little bit longer time frame. So you can trade this strategy off of any time frame that you want. Just keep in mind, typically the longer time frame you're looking on, number one, the fewer setups you're going to have likely, and number two, the longer you're going to need to hold it, okay? And which is always a little bit scary, in these markets, because as we're seeing right now, and like we saw in February, the market started, going south on us, and everybody that was holding swings that they picked up in January, man, they're bleeding hard in late February, March, April, and May. So just keep that in mind whenever you're holding these things for a longer period of time. That they can be a little bit scary. Let me give you another example of how you can trade this strategy. So you can look for bounces. Let's go back to a stock. Let's pull up semi again, and I want to show you guys a couple of examples if I can find them. That's always the challenge, is trying to find an example of what you're wanting to show. But so let's find a move up here. See if we can find one. I need to go a little bit further out. Give me 1 second here. Let's go. Nope, that's not what I want. Let's go here, time frame, and let's do 5 days on a 1 minute. Okay, now we should be able to find something here. Go back a little bit further when we had a nice move up. Here's our nice move up. Let's use this move. It's a little less dramatic. So there's another way to trade this. If you look at this move, okay, typically, not always, but typically when you're having these stronger moves up, your EMAs are starting to expand, right? Typically, they're going to hold decent support on that 9 and that 20 EMA, okay? And you can see as this move up happened, look how good the 9 EMA was holding support, right? So when you see that start to happen, and I even have said it several times, I think I even said it several times on Friday, where I would say, hey, look at how semi or whatever the stock was, look at how well it's holding EMA support. So we can look at possibly taking a trade off of an EMA bounce, right? So keep that in mind when you're looking at these stocks, because if they're holding support on 9 EMA here, well, they might continue to hold support on 9 EMA as they're continuing to go up. And every once in a while, if you see it dip down to the 20, well, that's okay. As long as it's holding support there, then if you do take a trade after it's bounced off of the 20 a couple times, maybe instead of putting your stop loss below the 9, maybe you put it just below the 20, right? So, and you can also see bounces inside of this expansion here, just like we did here. This didn't really hold support on either one to the penny. In actuality, it really held support on the 9. But you can look for these bounces to dip into this gap, just like it did here and here and here. So, this isn't always, hey, it needs to bounce right here at this blue line, or it needs to bounce right here at this yellow line. If it's somewhere in that gap, that's okay as well. So that's just another example of, another couple of ways that you can use those EMAs. And keeping in mind, you can also have all of them like I do up there. Let me go to my studies and load study set, and this is what I want. Does this have VWAP on there? Yeah, it has VWAP. So, okay. So, and you can use those other EMAs in conjunction with your 9 and your 20. But like I said, there's a lot of people when they're day trading, they're not really all that worried about the 50 or the 100 or the 200. They're looking at the 3 and the 9, or the 9 and the 20. That is 100% up to you guys. Just make sure that whatever you're going to use, that you're back testing that strategy that you're using, or those indicators that you're using, to make sure that you're using them in a way such that they've been profitable in the past, and especially recently. You can even, if you're going to be looking at trading this stock, so let's say that a stock ran on Thursday, and we're pretty darn sure it's going to run again on Friday. How many times do we see that, right? They run multiple days, consecutively. So if you're looking to do that, and that's your strategy for today, is you want to trade 9 EMA crosses above the 20, well, go look at yesterday and see how many times that happened, and how many times it would have been profitable trade for you. And maybe If it did it on Thursday, maybe it'll do it again on Friday. So something else to keep in mind there. Okay, take a quick break here for some questions. Does anybody have any questions about what we've covered so far? Like I said before, we're already right at an hour on this, and I know some of you may not have been in here whenever I said this early on. Y'all hadn't hopped in yet, but I was hoping to try and get VWAP and Fibonacci's covered in this particular session, but it's almost impossible because I just don't want to skim over anything. I want to be able to go in depth so that you guys can really find the best way to make the best utilization of each indicator, to see if it's going to be that important to you, or if you're like, I don't really care about all that stuff, I'm going to use something else. So Sam, to answer your question, Sam had a question for back testing. Do you back test for each ticker individually? So I have TradingView. Okay, so TradingView kind of has its own back tester in it, but you can do it manually. It just takes you more time to do that. It just depends on how far back that you want to go, but there are automated ways to back test it, and then there's a manual way. It just depends on what all you have access to. But TradingView is not very expensive. If you wanted to use it just for back testing, you could do that too. So how do I combine VWAP with these EMAs? So I just use it as another indication. So let's look at semi here. Let's find a move. So obviously right now with what semi's doing, would you guys say that it's in a bullish or bearish trend right now? I mean, you can just notice that just based off of the EMA, right? You can see, hey, well, we're trading below the EMA. We're even trading below the EMA. Let me see. Yeah, we're even trading below the 200 EMA on the daily chart. So we're definitely trading below it here on the minute chart, 1 minute chart. So yeah, we're in a bearish pattern here. We're trading below VWAP, we're trading below the 200, and that's what you're going to see. Whenever you're in a heavy downtrend, all of your moving averages are going to be reversed. Instead of your 9 being here, your 20 being here, your 50 being here, your 100 here, it's exactly the opposite. They're backwards. Your 9's on the bottom, then your 20, then your 50, then your 100, then your 200. And then a lot of times the VWAP will even be up above that. So I'm just using it, Sam, as another indication. So once we get into a bullish pattern, let's see if I can find a bullish trade on this thing, or a bullish uptrend. Okay, so once we're bullish like this, or like this one, this move here. So let's say that we had just for hypothetical, okay, let's say that we had a cross here of the 9 and the 20, and that's my strategy for the day. I'm gonna trade 9 crossing the 20 EMA strategy today. Well, if it crosses it right here, am I going to take that trade with VWAP and the 200 being right there? Well, probably not, especially if there was another resistance level there. So that's how I'll use it in conjunction. A lot of times also, Sam, you'll see that whenever, okay, let's use this example right here. So we've got a lot of different indicators here that could give support. We have the 20 EMA all in this area. We have the 200 EMA in that area, and we have VWAP in that area, right? So if for some reason we came down, we kept pulling back on that particular candle, obviously these would be different because these candles moved up. But let's just say, for good purposes, that all of it stayed the same, and this came back down here and was going to possibly bounce in this area. Would we pay more attention to that than if it was just bouncing off of the 20 EMA? For sure, right? Because there's several different indicators there that could possibly hold support. So that's how you use it in conjunction. And sometimes it's totally separate. Sometimes all your EMAs are way up here, the two that you're trading with, and your VWAP's below. and sometimes your EMAs are in the same area. Sometimes they're a little bit below VWAP. So that's how you use it in conjunction. Just another indicator to pay attention to as to where you might be able to see price holding or breaking through, or whatever. I mean, you can see how well here it held VWAP, right? We had pretty good VWAP consolidation, then finally it broke down. So I hope that answered your question about combining it with EMAs. So Doc, would you say that reversal, the question is, Doc, would you say that reversal at 9:33 a.m. was unusual? Let me find 9:33 a.m. here. I guess you're talking about this reversal. So maybe not, because you've got this this resistance level here. Let me squeeze this down a little bit. So you have this resistance level here at 580. So that could be the very reason that it broke down, because it got to 575, and it could be that 575 organic resistance level as well. Keep in mind, the cheaper the stocks are, the more organic resistance levels you're going to have. Are you going to have an organic resistance level at 50 cents on Tesla? Well, probably not. It's $600 or $500, that it's trading at. But when you're looking at a $2 stock or a $3 stock, and sometimes even a $5 stock, that 25 cents and 50 cents organic resistance level, that can be heavy resistance for those stocks. So keep that in mind, and that's exactly where this one broke down and started selling off, was at 575. So in my opinion, that would not have been unusual. And as you all know, trading with me for as long as you have now, especially in voice, y'all all know to be looking at those levels. I would, if I was in this trade, I would have been looking to either scale out or hop out of the trade all the way at that 575 level, and certainly 580, and certainly $6. So 580, just because it's a known resistance level. So Ackman, I hope that answered your question there. So I'm going to stop the recording here, and we'll go on with some other questions if we have some.